Please welcome Justin Tyler.
Okay. Peter, thanks for the introduction, and thanks everyone for your time today just to talk about some of these really important things in markets, particularly when it comes to fixed income markets, perhaps the poor cousin to equity markets in some ways. So it's great to see so many people here wanting to delve more into fixed income. So my name, as Peter said, is Justin Tyler. I'm a director and co-founder and also portfolio manager of Daintree Capital. Daintree Capital is a fixed income manager with an absolute return focus. And what does that mean? It means in simple terms that we seek to generate a target return for you, our investors, and to minimise the bumps along the road while we get there. Our main focus is on providing defensive alternatives. That means alternatives for those of you who might think that equity markets are looking a bit toppy. Alternatives for those of you who might want to park some cash for a little while. And so with that focus in mind, we're really happy to be partnering with eInvest to provide products in that space in a really easy exchange-traded format. Keep going. There we go. So I'll talk this morning at a high level about the options you have to earn income across the risk spectrum, and I'll point to some of the common pitfalls that you'll face as you delve into the many fixed income options that are available to you. And then finally, I'll talk about the eInvest products that are being managed by ourselves at Daintree Capital because they've been specifically put together to address some of those pitfalls. So just to set the scene, some of you may ask, well, why do I need fixed income in the first place? My equity dividend yields are paying me enough income. Why do I need to move into this asset class? And the answer is bad things happen in markets. They happen all the time. And so the ability to recover from a bad market performance is really important. For some people, it's not as good as it is for others. Perhaps you have an episode of ill health. Perhaps you need to have cash in your hands quickly for some reason. And when those things happen, that's when the diversity that fixed income can give you becomes really, really important. So I'd urge you all, don't let complacency blind you to the alternatives that are out there that perhaps you haven't looked closely at before, because they can really increase the stability and also the longevity of your income stream. And indeed, stability is really important. Indeed, it's what defensive investing is all about. The interesting thing, though, is that stability doesn't just depend on the investment. It depends on you, the investor, as well. Everyone has a different definition of stability. Some people need more, some people need less. So, for example, if you're looking to park cash for a year because perhaps you need it for a holiday in 12 months and you have it parked in an equity income fund, then perhaps that's not the best idea, because if you have a capital loss, then maybe your 4-star accommodation is now 3-star accommodation. That's not ideal for anyone. That's why we're really important. It's really important to us at Daintree to be offering not just one product, but in fact 3 products across the risk spectrum. You know, our hope is that we have something for people with all of their different sort of definitions of stability. Because make no mistake, if you are looking for a bumpy ride in fixed income, it can also be found pretty easily. If you look up there, you can see the returns, the annual returns over 20 years of the various different parts of the fixed income market, just the maximum and minimum returns over that period. And what should be pretty apparent is that when things go wrong in the higher returning parts of the fixed income markets, then really you're exposing yourself to returns on the downside that are not dissimilar to equity returns. And so I'd urge you all, if you see an investment and perhaps it's offering a yield of, 3%, 4%, 5% over the cash rate, ask yourself, what risk am I taking to generate that yield? Because make no mistake, you are taking risk in this low rate environment. The only way that you're going to earn that sort of return is to take some risk. And so you just need to be aware of what the risk is. Do I know what risk I'm taking? Is it being appropriately managed? because I'm going to talk about some pitfalls in a moment, and one of them is investing in fixed income with a return mindset but without a risk mindset. But first, before I get to that, passive investing. With apologies to David, who is just up here talking about a product that does a bit in passive space. In our view at Daintree, as active managers, we'd say that passive investing is perhaps a bad idea at this point in the cycle. It's not a bad idea all the time, but it's a bad idea for now, and this is why. I'm going to introduce this term duration. All of us in bond markets, we're perhaps a little bit nerdy, and we have our own sort of lexicon that we look at. Duration is one of these words, and what it essentially means is interest rate risk. So in simple terms, if you have a bond investment with a duration of 5, and then interest rates rise by 1%, well, you're going to lose 5%, and vice versa. And most passive products, their risk profile is dominated by interest rate risk. And you can see on the left-hand side what's happened to the interest rate risk in the Australian market since 2007. It's actually risen by 60%. So we'd argue that perhaps now's not the best time to be taking interest rate risk, and I'll cover that more in a moment. The other thing that we have some concerns about with respect to some products that are passively managed, not all, but some, is that they lack diversity. Up there you can see on the right-hand side the financials exposure of 3 different ETFs that are available in the market at the moment. And we would say that 100% exposure to financials is not diversity. In an asset class where the negative returns that can happen, as I've showed on the last slide, it can take years and years and years of income to make those things up. Diversity is just really, really important. The second pitfall is chasing performance. This chart shows you again, the black line is the duration of the Australian market. It's been going up over time, as I've mentioned. The red line is the yield, and the yield's been going very much in the opposite direction. You can see the blue bars, these are the annual returns of the Australian bond market. You can see a couple of things. Most of the time they've been positive, but in particular they've been positive when the orange line is going down. When yields fall, that's good for you as a bond investor. But the other thing you can see also is that on average the positive returns have been falling over time, and that illustrates a really important point about fixed income. Fixed income is not the asset class you go to because you're wanting prospective capital gains. In fixed income, the best you're going to get when your bond matures is you're going to get something close to the money back that you put in the first place. And so by definition, ongoing big capital gains are not possible in this asset class. And so it follows that chasing returns is not just a bad idea, it actually cannot work. It mathematically cannot work. So we'd really caution against chasing returns in fixed income. We'd also caution about reaching for yield. And I mentioned before the idea of just going for returns in fixed income and not worrying about the risks that you're taking. Well, have a look I'm not expecting people to read the right-hand side of this chart, by the way. This is just the laundry list of things that we can see that might potentially go wrong in the world at the moment. It's a long list, from problems in the industrial complex in the US to geopolitics, name your poison, it's probably on there. The takeaway is that of all times, now is probably not a great time to be taking too much risk in your defensive portfolio. It is meant to be defensive after all. It is meant to be protecting you when perhaps one or more of these things go wrong. And go wrong they will. And if you have a look at the right-hand chart first, that shows, I guess, the same story as the previous slide. Macroeconomic weakness is not good for credit in fixed income. So broadly, you can invest in government bonds, you can invest in non-government bonds in fixed income. If you invest in non-government bonds, you'll get paid a higher yield, but this is the stuff that can go wrong if you look at the right-hand chart. And if you look at the left-hand chart, 2 things become apparent. Firstly, when things go wrong, it's typically at the worst time. You want defensiveness at exactly the times there in 2008 and 1999. They're the times when you want your defensive portfolio to actually act defensively. And you can see that if you have too much credit in it, that's not going to happen. You can also see that that chart's by far and away dominated by low-rated credit. So all credit is not equal. If you invest in the investment grade part of the structure, if you're not taking a huge amount of credit risk, you can earn a sustainable extra yield. But as soon as you go down the credit spectrum, then you are playing with fire in what we would argue is a late cycle environment. Now, the final pitfall that I'll address is investing directly in bonds. Can I have a show of hands of anyone who's bought bonds directly in their portfolios? From FIG, there's a few brokers out there who do it, a few people. I'm here to tell you that there's a better way of doing it. And I'm going to tell you that by way of example. You can see two issuers up here, two bond issuers. These companies both issued in the Australian market. They both have issued over the last few years. Virgin has just issued recently. Mackay Sugar issued a bond in 2013, and when they did issue that bond, the yield was 7.75%, so it was quite attractive. But these bonds, when they matured in April 18, well, the company didn't have the money to pay investors back. And so what did they do? They deferred the maturity. In fact, they deferred the maturity twice. And then eventually, a white knight came in and took that company over, and those bond investors were forced to accept 50% of their principal, so a 50% loss. Not my definition of defensive by any stretch of the imagination. Virgin Australia, really well-known name, but its credit rating is single B. So Standard & Poor's will tell you that single B issuers default over a 5-year period 17% of the time. So again, I'd say to you, there's nothing inherently wrong with this. Some of you may have the risk tolerance to take these sort of risks. I'm just here to tell you to ensure that you do have that risk tolerance if you are going to take those sorts of risks. And I would say that our income maximiser product, which I'll talk about in a moment, is perhaps a smarter choice for investors with this sort of risk profile. It has a return target of 3 to 4% over the cash rate, but that income is sourced from several hundred different issuers. And so our job is to make sure that you're being properly compensated for the risk that you're taking in what is an asymmetric, risk profile. You can certainly lose a lot, but you're not going to gain a lot in fixed income. So the downside protection is really, really important. I'm just going to cover those, skip over those ones in the interest of time. What we were saying there is that investing in the Australian market only is perhaps not the best idea. It's just because the global capital market, the global fixed income capital market is massive, so you don't want to restrict yourself too much. eInvest has 3 products available. 2 of them will list in the next week. One of them, the Cash Booster, is listed at the moment. You can see that there's products there for all different risk profiles, and that's by design. I've got performance here for the Core Income Trust as well, so that's the ECAS ticker when it lists. You can see that 3.47% net of fees since inception. That's a little more than 2% over the cash rate, which is what we set out to do. There have been no negative months either, which is something that we're very proud of, almost 3 years without a negative return. The Income Maximiser product, shorter track record, but a bit more bumpy, and you would expect that because we are taking more risk and we are trying to generate a higher return for you. And so with that, I'd like to thank you all for your time today. I've described some of the pitfalls of fixed income investing. Just make sure that you're not susceptible to any of them. And look, with term deposits going backwards, and in real terms you are losing money in term deposits, and equity markets are perhaps looking a little bit late cycle, now is perhaps the time to consider spreading your wings and looking at some of these income options that are on offer, and particularly the eInvest offerings. They're easy to access, they're actively managed, they're relevant. I'd commend them all to you, and I look forward to addressing your questions at the panel that's coming up. Thank you very much.